What's up, guys? If you're new to investing, or if you're simply unsure of what stocks to buy, then this video is made just for you. I always get asked three main questions from people when they find out that I invest in the stock market and I do videos like these. The first question is, how much money have you made? Then the second question is, how much money have you lost? And then the third question, which is what we're talking about today, is how do you know what stocks to buy? Today I'm showing you my simple strategy that I use when buying stocks that helps minimize the risk of losing money into the stock market. You don't need to spend hundreds of dollars to pay someone for them to tell you what stocks to buy based on the research. We're going to show you this simple and practical way that you can utilize yourself, look at a company to determine whether it fits your investment needs or your investment strategy. The first thing I look at when I'm looking to buy stock from a company is, what is the company or what's the product? Is it a product that I use? Is it a product that I know is being used? Is it a product that I know people like? Mostly what I'm getting at is, does the product or does the company have a future? Is it have the ability to innovate? Is it going to evolve in the future? Or is it going to be stagnant and in a couple of years we're not going to hear this company anymore? Think of Blockbuster, think of the Red Box, right? Red Box was the bee's knees for a while until Amazon and Netflix, mostly Netflix during that time frame, just come in and just decimated them. And now I don't even know if Red Box even exists. I haven't seen them in the past really 5 years. Meaning that if the company doesn't foresee itself growing, if it don't foresee competitors coming and run them out of the market, or if it don't have that ability to innovate and evolve, then simply if you invest in that company, you're going to lose money. There's no questions about it. You're going to lose money. The stock is going to depreciate. It's never going to increase, and you're going to be wondering why you invested in a stupid company. So this first product or first company I'll talk to you about is Coke or Coca-Cola. Now, I personally use this product. Most people do. You're either a Coke or you're a Pepsi fan. But Coca-Cola is a product that is known not just in the United States, obviously, but this is an international brand. This is a company that started in 1892. It's headquartered in Atlanta, Georgia, and it's been well known in the stock market world. It's in many people's ETFs or mutual funds, being a S&P 500 company, and they have great products. Coke, Diet Coke, they own TrueMove. The list goes on and on of the companies that if you start researching, you may not even realize Coca-Cola owns. They're that big of a company. So now what I like to do is look at the basics of the stocks to give you an idea of why the stock is, I'm using this as an example of a safe or low risk stock. Right now their share price is around $51. Looking at their 5-year return rate, it's around 32% growth. Meaning if you bought one share in 2015 for around $38, $39, you would earn around $12 in capital gains. And in addition to the appreciation of the stock, Coke pays out a dividend each quarter. Right now their dividend is roughly 41 cents a share. So if you own one share for 1 year, you would earn roughly $1.64 in additional passive income. A key note for Coca-Cola is they've also grown their dividends for 31 straight years, making them a well-known dividend aristocrat. So since we're using products that I personally use, or most people personally use, the next one we're going to talk about is Clorox. Now, Clorox is a company that is headquartered in Oakland, California. They've been around for many years. Their brand is simply Clorox. You hear Clorox wipes, Clorox, the bleach that you put into your laundry to help get out any stains, especially with your whites. Now, they do have competitors such as Johnson & Johnson, Kimberly-Clark. As with any company, you don't have a competitor, but they are a stable company that has seen pretty decent growth the past 5 to 10 years, and we'll look at their basics of their stock as well. So like I mentioned before, Clorox has seen steady growth the past several years, and they have decent financials. Back in 2015, their stock price was around $113 per share, and now it's hovering around $212. Folks, that's a 93% growth the past 5 years. In addition, the past 10 years, the stock has seen a 221% growth as well. Their dividend payout right now is around $1.11 per share, which equals to $4.44 for an entire year in passive income. Like Coke, their dividends have also grown for 31 straight years. Now, the last example I'm going to use is Verizon or Verizon Wireless. Now, I personally have been a customer for them since I was a teenager, and before that, my parents, when they first got, I think the first cell phone that wasn't a bag phone, a little Nokia bricks, if you will, it was through Verizon. I've never left Verizon. Now, Verizon, as any company, has competitors. We see their biggest competitors right now are Sprint, they have AT&T, but overall, Verizon hasn't really been affected too much by those competitors. They've been a stable company that's seen decent growth the past several years, and I'll talk to you about the basics of their stock price right now. Verizon's share price right now is around $60 per share, and has seen an increase of about 35% growth the past 5 years and over 100% growth the past 10 years. They also pay out a dividend, and right now it's roughly 62 cents per share each quarter, and they've grown their dividends the past 7 years. Now, companies like Coca-Cola, Clorox, Verizon, they have their ups and downs. They're not immune to pandemics or economic downturns. But for the most part, people view these companies as a low risk or safe investment strategy to add to their portfolio. If you look at most mutual funds that are balanced or a growth mutual fund, or even a lot of your ETFs that run off the S&P 500 index, chances are any one of these three companies, if not all of them, are going to be a part of that index or part of that fund, because they're stable companies that are generally able to weather the storms because they have such a good product or such a good future in consumer market that it really doesn't affect them too much when you have COVID-19 hitting or you have the housing bubble collapse of 2008, 2009. As with a lot of things financial related, the bigger the risk, the bigger the reward. So my caution to you is, if you're looking at buying Verizon, Coca-Cola, Clorox, companies like these, Johnson & Johnson, Kimberly-Clark, for instance, Verizon is obviously $60 a share. If you buy in today at $60 a share, don't expect their price to hit $100 a share next week. But also, I wouldn't expect their share price to drop $10, $15 a share over the next week either. Companies like these are a great way to invest in, learn the market without really the big risk of losing your money, and at the same time you're going to earn the appreciation of the stock as it goes up, and they also pay out that extra dividend, which helps put a little extra money back in your account, or you can take those dividend earnings and reinvest it and buy additional shares for the company. So to recap, to give you an overview, take a common sense approach to investing. Don't make it overcomplicated. Don't get overwhelmed by all these strategies and people selling subscriptions or articles. Here's how I look at it. Do you like the product? If yes. Do you use the product? If that's a yes. Do you see the product or the company having a future or being able to evolve with the ever-changing markets? If you answered yes to all three of those, then take your time. Look at the stability of the company. Do you see it being around? Look at the financials. Are they at risk? Are they in a lot of debt? Are they able to weather economic downturns such as COVID-19 and industries being shut down? Take that approach to it. Do not make an emotional decision. Don't take a rush decision, because at the end of the day, it's your money and you want to see that money grow in the best way possible and get those capital gains and earn those dividends. Folks, that's all I got today. I hope you liked the video. If you have any comments or if you have a different strategy that you use when you first started investing, I would love to hear that and share it with everyone who may watch this video. Please put those in the comment section. If you haven't already, hit the like button, hit the subscribe button, and as always, we'll see you on the next video.